welcome to the podcast. I'm your host Amit Kirti. In this podcast, I'll talk about my learnings from stock market investing. I started investing in the Indian stock market in the year 2004. With zero knowledge of the stock market, I went by the recommendations that I saw on the TV. I bought whatever was cheap, and by cheap I mean stocks with ticker price less than 100 rupees, which doesn't necessarily mean that they are cheap. I bought stocks like Ashok Leyland because it was available at 25 rupees per share. I also bought shares like TTML, SAIL, Tata Steel, Bajaj Hindustan, and whatnot. Completely oblivious to profit and loss statements, balance sheets, and cash flows, I continue to rely on questionable resources beyond me to decide on investment decisions. Hence, between 2003 to 2008, when the entire world was making money in telecom and infrastructure, I was busy buying duds. I completely missed making money during the golden period between 2003 and 2008. The only solace I had was the fact that I had bought Yes Bank post their IPO and I sat on it to eventually make some profit. When the crash of 2008 hit me, I was completely caught off guard. Since this was my first brush with a downturn, I panicked and I sold all my shares somewhere around 2009. I sold my shares at a loss. Yes Bank was the only one where I had made some money. I bid adieu to the stock market with a vow not to return back. Between 2009 and 2012, I kept watching the markets. I saw all my shares reach their heydays back, but then I was not there to see my losses recoup, as I had already sold them in the panic of 2008-9. I learned my first lesson about the stock market sitting on the sidelines all the while. That is, downturns are not forever and the losses are never permanent. Eventually, there will be a recovery and good companies tend to bounce back. During my first stint, I bought a company whose name starts with T again. Based on the ticker price and based on the profit displayed in the P&L statement. I received dividend only once, even though the company announced frequent dividends. I never realized that the management was shady till one fine day when the company suddenly vanished. This led me to my second learning. That is, management pedigree is the bedrock of a successful company. During my hiatus from the stock market between 2009 and 12, I kept reading though. I learned about the different sectors in the market. I read about cyclical and non cyclical sectors. When I look back at my initial debacle, I realized that most of my bets were on cyclicals. I tried to introspect the reason for this, and I realized that I was swayed by the media, which was predominantly focused on cyclicals. Moreover, the non cyclicals were called defensives. I didn't like the term defensives. 2008-9 downturn exposed the leverage cyclicals, and probably I got caught in the ambush. This led me to my third learning. That is, long term investors are better off staying away from cyclicals. With this understanding of cyclicals versus non cyclicals, I started off looking for sectors and companies that are inherently non cyclical, that is, secular growth stories. After reading many books and articles, I understood that in India, the major non cyclical sectors are pharmaceutical companies, information technology companies, banking and financial institutions, and consumer based companies. By 2012-13, I was mentally ready to get back to the market. I started off by investing in a non cyclical Aurobindo Pharma. By sheer luck, Aurobindo Pharma multiplied 3 to 4 times within a span of few months. However, due to my apprehensions, I had invested a very tiny amount. Even with this small amount, I could see the impact of a 3 to 4 fold compounder. This was my fourth learning. That is, an investable idea with growth potential has to be backed by substantial capital. Position sizing is a critical part of investment process. After the initial 3 to 4 time jump, I realized that I should have invested more when the price was less for Aurobindo Pharma. I invested more, but the subsequent gain did not match the initial jump. In the meantime, I found another non cyclical in the form of Gruha Finance. I invested a decent amount in it, and I kept waiting in both Aravindo and Gruha Finance. I saw appreciation, but it was in line with the rise in market. I stayed with Grow for a few years. The 20% odd return was not in line with my expectation, so I moved out of Grow. As soon as I moved out, I saw a twofold jump in the stock price of Grow. This got me thinking. I relooked at the history of Grow and I did some introspection. This led me to a very important learning for which I am thankful to these companies, as well as another company called Ajanta Pharma. So, my fifth learning was substantial backfilling of fundamentals precedes stock price appreciation. Patience is a virtue. Let me elaborate this further. In case of Aravindo Pharma, it had gone through years and years of below par returns. During this phase, there was a backfill of fundamentals taking place. The company was trying new drugs, biosimilars. It was trying to capture market share, and all this while the stock price did not inch up. Due to these efforts, one fine quarter in 2013-14, there was a huge jump in the bottom line. The company was able to sustain the profit for the next couple of quarters. This led to a re-rating of Aurobindo. I was lucky to have jumped in the quarter that saw marked improvements. Now, in the case of Aurobindo Ajanta Pharma, it had already gone through a huge growth that was accompanied by multifold increase in the share price. So when I entered Ajanta, it was and is still going through a backfill for the next phase. Hence, I did not gain much from Ajanta. I have had the same experience with Granules as well. In case of Granules, it went through a growth cycle around 2013 to 2015 period. The share price also saw a tenfold increase during this period. From 2016 till date, the company has been backfilling its capacity and gearing up for the next phase of growth in oncology, the US facility, API capacity expansion, and filing of new ANDAs for the next cycle of growth. I do not expect Granules to grow much till 2020, which is when we should expect the next spurt. In my first shot at investing, I had picked Yes Bank. So I had some experience owning a bank. When I realized that financial institutions are not cyclical, I had an aha moment and I set out looking for financial stocks. Finance is a gamut of companies comprising of public sector banks, private banks, NBFCs, MFIs. Now, lending is an inherently leveraged play. The company leverages 8 to 10 times, and a 10% default or NPA will wipe it out. So lending is a risky business, and the company management is the single most important thing for such institutions. I realized that housing finance was the safest bet and decided to look at them. There were and are only a handful of listed housing finance companies in India right now. Among all the available options, I had shortlisted PNB Housing and HDFC. The management of both the companies seemed top notch. PNB Housing Management's growth ambition and the future growth potential tilted the balance in PNB Housing's favor. Owning finance stocks over the past few years has taught me my sixth lesson. That is, credit is a fundamental building block of any corporation or individual. Able, stable, and believable credit providers should be part of one's core portfolio. Now, there are many types of credit providers banks, MFIs, SFBs, plethora of NBFCs, and one is spoiled for choices. I decided to invest in housing finance for the following reasons. One, housing loans are generally backed by collaterals like the house itself, and housing loans are the last ones that people generally default. Housing loans are a long term contract. The switching cost or the switching process acts like a proxy moat. Hence, the housing finance companies are generally assured of revenues for a sustained period of time from the existing customers. In order to grow, housing finance companies have to only find the delta, that is, new customers, which is equal to their planned growth rate. 2018 was the first downturn that we experienced in the past 5 years. For a totally different reason, I had stopped investing in stocks from January of 2018. All my money was getting accumulated in FD for a rainy day. By the time I figured that the rainy day has been pushed to a future date, I had accumulated some cash which got invested during the downward spiral of October and November of 2018. I realized the importance of being in cash. Even though it is common sense that investing in dips is prudent, experiencing it firsthand was a revelation to me. This was a major learning for me this year, which is my seventh learning. That is, being partly in cash is the trait of a smart investor. So these are my learnings from the stock market investing. Thanks for listening. Goodbye. We'll meet again in our next podcast.